But let's turn to the broader market and whether we are to expect more FI selling through the month of February. So far it's not been too bad, but yesterday we did get a fairly negative FI number. Haresh Shivdasani, Managing Director and Head of Equities at HSBC, joins in to talk about that. Haresh, morning. Thanks for joining in. At the conference, what's the key concern that you're hearing about? Is it earnings growth and general macro growth, or is it is it more about inflation and interest rates?
I think the sense that I have got speaking to investors is that the concern is not growth. The concern is near-term headwinds. I suppose the obvious one is inflation. That is something that investors are trying to grapple with in terms of where does it peak out. I think they recognize that it has got to elevated levels. They just want to try and get some sense of clarity where it could peak out. I think the caution also arises from the fact that we are seeing interest rates move up right now, and they are here to try and understand where interest rates can head and where they can peak out. So I think the recognition is that we are perhaps somewhere in mid-cycle, and typically my experience is that, in mid-cycles these are times of caution. So I think the growth is not so much the concern. I think it's more the inflation, the interest rate scenario, and where we are on the capex cycle.
Haresh, morning. Of course, in that your keynote address was by the Deputy Governor Subir Gokan. What did investors take away from his body language and tone in terms of what the RBI may do through the rest of this year?
I think the message that I took away, as did several investors, was that the central bank has an eye out for growth. I think growth is the message as I understood. However, I think they need to also keep in mind that they have to try and contain inflation at manageable levels. So to me, they are in a little bit of a tight spot, so to speak, where they have to keep an eye out on the inflation, but they certainly want to encourage growth. So the key that I took away from investors is investors would like to see actions being taken to tame inflation, but yet not to constrain the growth.
You had nearly 65 corporates attending, Haresh, and the crux of the problem for the market right now is where earnings growth may be headed. Did you sense some kind of skepticism amongst the corporates on what they could deliver in earnings?
I think body language has been fairly positive from the corporates. You have to bear in mind that the corporates themselves do recognize that they are in an environment where interest rates are hardening. So that certainly doesn't get them to feel so very excited about how things have been over the last few years. However, I think they have the confidence to deliver. I think they also recognize that these are phases in business cycles that they have to contend with. Some of the corporates did mention that, that is part of business cycle in any case. So I think there is a maturity about corporate India. I think they have the maturity to understand where they are. I think their view is that, we will go through these periods. My sense is that, that implies that you may not necessarily see such robust earnings growth as you may have seen over the last couple of years. But that doesn't necessarily mean that we are moving into an earnings deceleration cycle. I think we are sort of, tempering out, if that's the right word.
But given the kind of shaky start we've had to the year, Haresh, are you tweaking your Sensex targets for the end of 2011?
I think our Sensex target for 2011, as our strategist has advocated, is 21,000. At these levels, it might seem that offers you a large upside. I think that's probably the way to look at it, that perhaps valuations are getting attractive and there may be a case to start investing money back in the Indian markets if you do believe that 21,000 on the Sensex is a number that can be hit sometime towards the end of 2011.
But you met a lot of the CIOs of the big global funds and they have been reallocating their portfolios between developed and emerging markets. What's the sense you took away in your interactions with them specifically?
I think I'd probably summarize by saying that it is cautious optimism at the cost of sounding cliched, but we had a fairly diverse participation on the CIO panel. We had investors both local and international, and when I say international, they were India dedicated or India focused, as well as emerging market portfolio managers. It was very interesting to hear a lot of them say that there are positives out there. They did recognize that there are near-term, immediate-term concerns from the standpoint that India is sort of going through a slightly difficult phase. Very interestingly, a couple of the CIOs on the panel pointed out that they were happy to see the kind of corruption, if that's the right word, related issues coming out into the open. They thought that that actually is a positive sign, that they are getting to see things like that now coming out into the open, as previously where it was not so well put out in the press and the media. So I think there is a sense of optimism. The portfolio managers did give the view that India is potentially now maturing more and more as we go along. They are bringing things out into the open, so they recognize that things need to be addressed. And the message was that as long as you are doing that, we hope that you will take corrective action. So there is optimism, there is positivity that's being viewed out of every scenario. I think that's coming from the fact that they do see India as a long-term growth opportunity.
The big fear though for this market, Haresh, is the kind of outflows it will have to live with, something that's only just started in January and through February. What's your sense of where flows may go this year?
Let me start by putting in a caveat. I cannot forecast flows. It's very difficult. However, I will try and put this in a little different context. What I have seen and what I get as a sense is that in the first half of 2011, it's not necessarily going to be an easy period for India in terms of receiving inflows. I think you are seeing and you have seen that the developed markets, especially the US, is where money seems to be going back. You have seen about $10 billion going out of emerging markets. So India seeing outflows is not just an India-specific situation. It is part of an emerging market asset class, number one. Number two, I think India tends to be amongst the high beta stocks high beta countries, in any case. So, which is typically how emerging markets are. So the fact that India has delivered very strong returns in 2010, India has the growth potential, and India typically may be looking relatively rich in a sense, it tends to be a high beta economy or high beta market as well. So I think we've got to view it in that context. And with that being said, I think if the US does sort of peter out, you will see flows going back to emerging markets. It seems like the consensus view I'm picking up is that the second half of 2011 is when you could see flows returning. I don't necessarily believe that it will end up being as high as 2010 from a net inflow perspective, but I'm hoping that it will see a reasonably healthy number in the second half at least.